You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. We're here to give you that shortcut, really cut through the noise and get you up to speed on what's actually driving the global economy.
Yeah.
Today, we're digging into this global market and geopolitical briefing, pull out the key stuff, connect those dots, and, well, show you what these big global moves really mean for you. We're talking FX, commodities, trade, geopolitics, the whole picture.
Yeah, and it's a really packed briefing this time. Lots of crucial intelligence in there. Our job, as I see it, is to get past the headlines, find the why it matters behind all this data. We want to help you decode what's shaping things so you walk away understanding not just what's happening, but maybe what's coming next.
Okay, let's jump in. First up, central banks and the global economic pulse. It feels like every monetary authority is walking this tightrope, right? Balancing inflation and growth. Let's start with China, the PBOC. They held their key loan prime rates steady, 3.00% for 1 year, 3.50% for 5. Mostly expected, I gather, even with their economy looking a bit sluggish.
That's right. It was widely anticipated. But what's significant here is how they're choosing to manage things. They're consistently going for these targeted structural tools instead of, say, broad rate cuts. You saw that 600 billion yuan injection via the medium-term lending facility loans. That's a key signal. It's about stabilizing credit growth carefully, not just flooding the system.
Right, so less of a big splash, more pinpoint accuracy, trying to shore things up without maybe overheating other areas.
Exactly. Precision over blunt force. Broad cuts could risk fueling property bubbles again, or maybe adding to local government debt worries. These targeted tools let them channel funds to specific areas, maybe SMEs, infrastructure, without necessarily encouraging widespread borrowing. It's about stability, controlled growth.
Okay, got it. So from China's careful approach, let's hop over to Australia. The RBA's got its own challenges.
Yeah.
July's inflation expected to tick up slightly, 2.3% year on year from 1.9%. Doesn't sound huge, but what does that mean for them?
Well, it certainly complicates things for the RBA. Especially, right after they cut rates by 25 basis points, bringing the cash rate down to 3.6%. A stronger inflation print now. It kind of throws a spanner in the works for any further easing plans. It makes you ask, well, did they move too soon on that cut? They're in a tricky spot. Support the economy or risk inflation getting stickier?
Yeah, that's a tough balance. Speaking of which, Sweden's Riksbank seems to be in a similar boat. We're waiting on their minutes, but what's the general feeling there?
They've been pretty open, actually. They acknowledge the inflation surprises, sure, but they're still quite worried about weak growth. The official line is still that the door's open for more cuts later this year if growth stays weak. It really highlights that global dilemma, doesn't it? Inflation might be nagging, but if the economy's stalling, central banks often feel pressured to lean towards supporting activity. It's a gamble.
Okay. And the euro area. The ECB is releasing minutes too, but you're saying not much market shift expected from those.
Probably not from the minutes themselves, no. The ECB's kind of in wait-and-see mode domestically, letting past hikes work. But, and this is crucial for them, they're keeping a very close eye on external factors, especially the threat of potential U.S. tariffs on the EU. If that happens, big impact on exports, maybe feeds inflation, complicates their job significantly. So domestic policy might be steady, but they're definitely watching trade tensions.
Right, so the ECB watches Washington while Washington, well, the Fed is watching its own data.
Yeah.
The U.S. PCE deflator is coming up. That's a big one for them. July's core PCE projected up around 0.26% month on month, potentially pushing the annual rate near 3%.
Exactly. And the PCE is the Fed's preferred measure, remember. It gives a broader picture than CPI. A move towards 3% core PCE definitely tests that higher for longer idea. They're balancing these persistent inflation pressures, some potentially linked to tariffs, ironically, against signs the labor market might be cooling off. If inflation, especially this measure, stays sticky, it just gives the Fed less wiggle room on rates, even if job growth slows down a bit.
It's a real juggling act. Okay, let's head north to Canada. GDP figures for Q2 are due. Expectations seem pretty low, barely any growth, weak exports, weak investment.
Yeah, the forecasts are quite subdued. And if that plays out, if growth really is that anemic, it definitely ramps up the pressure on the Bank of Canada to think about cutting rates again. If the economy's stalling, especially due to external factors like exports, monetary policy might need to step in. A weak GDP number would certainly fuel expectations for a cut before the year ends, maybe a more dovish turn than some expected.
Okay. And wrapping up the central bank tour, Japan. Tokyo CPI for August is forecast to ease a bit, 2.6% from 2.9%. Sounds like good news.
On the surface, maybe? But the key thing to watch is the underlying inflation, the measure stripping out food and energy. Those are likely staying stubbornly above 3%. That suggests inflation isn't just imported shocks anymore. It's becoming more, embedded. The stickiness, especially if wages keep rising, it keeps the Bank of Japan's options open. They could still tighten later this year, move away from that ultra-loose policy. We also need to watch the other Japanese data coming out, retail sales, industrial production. That'll tell us if domestic demand is holding up against weaker exports. Gives a fuller picture.
Right, so even easing headline numbers don't tell the whole story there. Okay, we've covered the policy tightropes, but sometimes, say, external shocks just hit, right? Let's move to our commodity watch. Energy, minerals, metals, critical stuff. And starting with oil, there was this disruption, the Druzhba pipeline, near Russia, Belarus. Flow suspended for days.
Yeah, reported out of Hungary. Flows stopped for at least 5 days. It's a perfect example of geopolitics hitting energy security right where it hurts. Druzhba's a key route for Russian oil into parts of Central Europe, so any halt rings alarm bells. Germany said its own supply wasn't impacted. They're probably more diversified now. But Hungary and Slovakia, much more reliant. They've asked the EU Commission for help ensuring long-term stability. It just highlights that ongoing vulnerability, especially for countries still linked to Russian supplies. Physical pipelines are still powerful geopolitical levers.
Definitely a vulnerability. Okay, shifting from energy to strategic minerals. China's industry ministry, taking steps to tighten control over rare earths. Mining, smelting, separation.
Yes, interim measures announced. And this is really significant for global supply chains. Rare earths are in everything, right? EVs, phones, defense tech. China dominates production. So by tightened control, Beijing isn't just managing resources, it's signaling, quite clearly, its intent to exert more strategic influence over these critical minerals globally, connect that to the broader US-China competition. It's about controlling future tech and the materials needed for it.
Strategic leverage, not just supply management. Got it. What about precious metals? Gold seems kind of stuck, range-bound below its 50-day average.
Yeah, gold traders seem to be holding their breath a bit, waiting for clarity. The price is really sensitive to hints about U.S. inflation and what the Fed might do next with rates. Gold loves uncertainty and lower real rates. Until we get a clearer signal from the Fed or maybe a major geopolitical flare-up, it's likely to just consolidate like this.
Makes sense. And quickly on industrial metals, copper. Prices consolidated, held steady after recovering last week. Copper is the economic bellwether, isn't it, Dr. Copper?
That's the one. Its price often gives a hint about global economic health because it's used everywhere, construction, manufacturing. The fact that it's consolidating now, after a bit of a recovery, suggests maybe cautious optimism. Not a boom, not a bust. It implies the economy isn't falling off a cliff, but there's no huge surge in demand pushing prices way up either. Stable, but not signaling strong growth yet.
Okay, interesting nuance there. So we have the economic forces, the commodity shifts.
Yeah.
But the geopolitical backdrop is always there, isn't it? Let's turn to some key hotspots, starting in the Middle East. Reports that Israel's defense minister approved army plans targeting Hamas in Gaza, including civilian evacuation plans.
Yeah, that signals a potential escalation, obviously carrying huge risks for the region and humanitarian concerns. And at the same time, you've got Iran prepping for nuclear talks with European countries while also facing new U.S. sanctions on its shipping entities. It just shows how complex it is. Military action, diplomacy, economic pressure, all happening at once. A very tangled situation.
Very tangled indeed. Moving to Eastern Europe, Ukraine still facing heavy Russian attacks. President Zelensky warning Moscow's actions are aimed at avoiding real peace talks.
Right. And add to that, Russia launched naval exercises in the Baltic Sea recently. These aren't just routine. They're clear military posturing, projecting power, testing NATO. Combined with the strikes in Ukraine, it suggests Moscow intends to keep up the pressure, militarily and diplomatically. Makes any path to peace talks incredibly difficult. And keeps regional tensions high.
And East Asia. North Korea's Kim Jong-un praised military officers for overseas operations. What could that mean?
That phrase, overseas operations, it's rarely straightforward from North Korea. It could hint at anything from, say, supplying weapons to others, maybe Russia, or possibly cyber activities. It signals their continued effort to be, well, assertive on the world stage, often through means outside normal channels. It reinforces their alliances and capabilities, always worth watching closely.
Right, always read between the lines there. And finally, South America. Clear signs of U.S.-China competition playing out near Venezuela. China condemning U.S. naval deployments.
Yes, and then almost immediately after that condemnation,
Yeah.
you had Chinese companies pledging over $1 billion in new investment into Venezuelan oil fields. It's a really vivid illustration of that strategic competition. The U.S. makes a security move. China responds with an economic one focused on critical resources like oil. It's about influence building.
A direct countermove economically.
Okay,
let's bring this back home with our last section. U.S. policy and global implications. We keep hearing about tariffs and trade. U.S. officials saying higher tariffs risk fueling inflation by raising goods costs. Is it that simple, though?
Well, it's complex, isn't it? Tariffs do raise the cost of imports, yes. But whether companies can fully pass that cost on to consumers depends on demand. If demand is weak, they might absorb some of it. However, even if not fully passed through immediately, those tariffs add to business input costs. That creates this kind of underlying persistent inflationary pressure. So maybe not a direct immediate hit always, but it definitely adds another layer of inflation risk for the Fed to worry about.
So a policy aimed at one thing, but with these knock-on inflationary effects. Related to that, on the domestic side, Washington is reportedly looking at shifting some CPI Act money, maybe $2 billion, towards critical mineral projects.
Exactly. And that really highlights the link they're making between supply chain security and strategic competition. The CHIPS Act was about semiconductors, right? But you can't make semiconductors without critical minerals. And since many of those minerals are controlled by rivals, Washington's thinking, okay, we need to secure the upstream part of this chain too. It shows how domestic policy focused on tech security immediately branches out into global resource competition and geopolitics. It's all connected.
Absolutely connected. Okay, so wrapping this all up for you, our listeners, what are the big takeaways? We've seen central banks everywhere doing this incredibly delicate dance between inflation and growth, often facing contradictory signals. We've seen commodity markets flashing signals, some volatile like oil pipelines, others strategic like rare earths, some just waiting like gold, and persistent geopolitical hotspots simmering across the globe from the Middle East to Eastern Europe to East Asia and even South America, often intertwined with that U.S.-China competition. These aren't just abstract stories. These are the currents shaping the global economy right now.
They really are. And maybe the final thought to leave you with is just think about how interconnected it all is. A pipeline issue near Russia impacts fuel prices. A central bank move in Australia ripples through global finance. A new investment in Venezuelan oil shifts regional influence. How might these things, which seem separate, actually combine in unexpected ways in the coming months? That butterfly effect. It's worth considering how developments in one corner of the world might create ripples that eventually reach you. Keep an eye on how these threads might weave together.
Worth thinking about. Thank you so much for joining us on this deep dive. Keep digging, keep exploring. We'll catch you next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.